Let us discuss today stop loss. Now, first of all, let's get something straight. You have to have a stop loss somewhere. Whether you are a day trader, a scalper, or a long-term trader, or a swing trader, whatever, you need to have a stop loss. All right? You might find in some places some good traders that do not use stop losses, but these guys are probably knowing what they do. They know what they're doing. For retail traders, for amateurs, it is highly advised that you have a stop loss. Otherwise, you will start having losses that you cannot afford. So the first point is you need to have a stop loss. The second point is that the stop loss has to be within outside a random fluctuation range. What do I mean by that? In a short term, stocks, indices, currencies, all financial instruments can move randomly. Can have moves that do not have any meanings, right? So if you take a range, a time frame of, let's say, 1 hour or 30 minutes, well, the stock or any financial instrument can do anything, right? It can go against the trend, it can go up, down, whatever. It's usually meaningless. Moves within a short-term period are meaningless, right? But when you start moving into a longer time frames, at least 4 hours, but I would say 12 hours to dailies are better, then the moves start making more sense over longer time frames, all right? And therefore your probability of success will increase provided that you have a good strategy. So my advice here for you is to use time frames that are at least 4 hours. Day trading and scalping is statistically a losing game. Right? It doesn't mean that you don't have few traders that make money from these time frames, but overall for a retail trader, I highly recommend that you use at least 4 hours, preferably daily time frames. All right? Your probability of success will improve provided that you have a decent strategy, a tested strategy. All right? So this is my second advice. Please use long time frames, at least 4 hours, preferably daily and more. Okay? Now, my third point here is to make sure that your stop loss, whatever your strategy is, to make sure that your stop loss is at least within 2 average true range distance from your entry point, or within 2 standard deviations of your entry point. All right? So let me explain. You probably have a strategy, right? Now this strategy will be based on maybe some technical indicators, fundamental indicators, potentially also some quantitative indicators that you can find available or that you can create yourself. All right, so you will have, based on that, you will have an entry point and exit points, which are your stop losses if it goes wrong, and then a take profit if it goes as you are expecting or as you're wishing, right? Now, make sure that your stop loss is at least 2 average true range from your mean, or 2 standard deviation from your mean. Now, standard deviation and average true range are measures of volatility, right? And thus they are measures that reflect the volatility. So when the markets are very volatile, then the range and the standard deviation will be higher. When the volatility is low in the market, then the standard deviation and the average true range will be lower, right? I tend to prefer the average true range because the standard deviation assumes that you have a normal distribution. Now it's a statistical distribution that is called normal distribution, and they actually don't. You might have some financial instrument whose statistical distribution is close to a standard deviation, but most of the time they are not. right? But the average true range is a measure of range, right? Let's say daily range. And it's a very good, and in my opinion, it's one of the best technical indicators that are available because it's meaningful. It really gives you a good story about, or a good indication where to put your stop loss point. So to recapitulate, if you want to increase your probability of success, first of all, you need to have a good strategy, right, that you have to test. And based on this strategy, you have a criteria or a way of deciding where your stop loss is. Just make sure that your stop loss is always more than a two average true range or 2 standard deviations. I have personally run thousands and thousands of simulations, and I can scientifically and for sure tell you that when you are outside the 2 standard deviation or outside the 2 average true range, your probability of success increases substantially, simply because you are outside the random volatility range. All right? I hope this was helpful. Now, and just a final point, when you actually do that, you might actually have a stop loss that is kind of distant or far away from the entry point, but this is really the only way of assuring that a retail trader can make money in the long range, right? So that implies that with this kind of approach to the stop loss, you need to have a lot of patience, right? Meaning that if you get into a trade, it might take days and even weeks sometimes to hit your stop loss or to hit your take profit. All right? So I wish you well, and I wish you happy trading. And remember that trading is very risky, that trading is not for everybody, and that trading requires a lot of rigor, focus, and self-discipline. All the best.